Good morning. On behalf of the members and associates of Williams Keepers LLC, I'd like to welcome all of you to this special boss presentation where we will cover some topics from a massive piece of legislation that was signed into law only 16 days ago, but I have to admit it feels a lot longer than that. I'm Mark Gingrich. I'm one of the partners in the tax side of Williams Keepers, and I'm pleased to be joined by my fellow tax partner, Jeremy Morris. We've pulled from the legislation that was passed this December the topics we think are the most urgent and important for our client base. And as always, we'll try to frame those in the way that's most helpful and instructive to figuring out how they're going to affect your business. The topics we're going to cover today layer on top of almost a year's worth of coronavirus legislation. We have the March 2020 Family First Coronavirus Response Act, or FFCRA, we'll talk briefly about. We also have the all-popular CARES Act, COVID Aid Relief and Economic Security Act that's from way back in March 2020. In April, we saw the Paycheck Protection Program and Healthcare Enhancement Act, followed by June's Paycheck Protection Program Flexibility Act. And then we had a big hiatus for about 6 months while Congress figured out how they were going to jockey over the election. And ultimately, we have the Consolidated Appropriations Act, which is a massive 5,500-page bill. And that has several acts contained within it. We're not going to refer to any specific sections or acts as we cover this material today. We're going to try to frame it in a way that helps business owners make business decisions. So we're pleased to have the opportunity to share our thoughts with you today. We have quite a few folks on and hopefully a few more joining us as we get started. So let's advance to the next slide, Jen, and we'll look at a roadmap for today's presentation. All right, we're going to cover 6 of the 7 things you see here on the slide. We're going to start off looking in our rear view mirror with the first 2 items. We're going to talk about what has happened with the Paycheck Protection Program that was. Many of you likely received PPP loans over the past 10 months or so, and we'll talk about what the impact of December's law changes are on loans that have already been issued. We'll also spend a little bit of time talking about a topic we covered over the summer called the Employee Retention Credit. And we didn't pay much attention to it, but for reasons you'll see in a moment, there's reason to revisit the Employee Retention Credit. We'll then pause on item 3 and talk about the impact of these changes looking in the rearview mirror on those of you facing the question when and how to apply for forgiveness on your PPP loans. We'll then turn forward looking to 2021 and talk about a new round of PPP loans that are available to some businesses, a new enhanced employee retention credit that's available for the first half of 2021, and then just before breaking for your question, time permitting, we'll talk a little bit about an expansion or an extension of the FFCRA requirement to provide paid family leave for certain businesses. So if we have time for all of that while we're together, it will be amazing. And Jeremy, without further ado, let me turn it over to you and let's look in the rearview mirror and figure out what's happened on PPP as a result of December's law change.
Yeah, thank you, Mark. Appreciate that. And you're exactly right. Given the breadth of this bill, it will be somewhat surprising if we can get through all of this, even as focused as it is on just these few items. Again, good morning. Happy to have all of you here. As always, before I begin, if there are any questions you have, please use the Q&A function, and we'll do our best to answer those questions as we go along, if appropriate, or at the end, if we have time. So as we continue on this journey that we've been on with you, and that's still not ending anytime soon, that we've been on for about a year now, we'll start with retroactive changes to PPP. And one thing I want to keep in mind as we talk about PPP 1, which were the first draw loans, and then the second draw loans, which would be those for those businesses that have already received a PPP loan. We have two different loan programs, but when we talk about these retroactive changes as well as these prospective changes to PPP, we're talking about that generally. So unless stated otherwise, these retroactive changes apply to both programs. It's when the provisions became effective. Did they become effective as of the date of the CARES Act? In which case they're retroactive, but that doesn't mean they just apply to PPP1. In addition, when we talk about prospective changes in a minute, again, those are changes that are effective as of the effective date of this bill, which was December 27th. But again, in most instances affects both PPP1, the first draw loans, and PPP2. So just to get that out of the way. So first retroactive change, we need to get this one out of the way right off the bat, because this was something that was important to a lot of our clients, particularly almost all of our clients, as we looked at year-end planning, and that's this. Expenses funded by forgiven PPP loan proceeds are now deductible, okay? So the idea behind these was that these were supposed to be non-taxable forgiven debt, these PPP loans. The problem was Congress didn't really get everything buttoned up correctly when they drafted this bill. And so the IRS came in and said, well, that's great, but the expenses that fund this tax exempt income are now non-deductible, which thus made the PPP funds taxable for all intents and purposes. That has been fixed with the CAA, and that's just what we're going to refer to this as throughout this presentation, as opposed to the specific acts within. But that's been fixed with this. So all loans, whether it's existing PPP loans or any PPP loans, both draw one and draw two, all of those expenses that you pay for with PPP funds are deductible expenses for income tax purposes. So that's one of the nice things. Now that is for federal income tax purposes. I'll just give this little caveat in here, is that the one item that we will have to look at is states, because states may or may not choose to conform with that. For purposes of Missouri, Missouri is a rolling conformity state, so it conforms to federal tax unless the decision's made to explicitly decouple. So for most of our clients, you're okay on the federal side, we're okay for Missouri, but if you operate in multiple states, that is something that we will need to look at. Second retroactive change. The categories of good cost eligible for forgiveness have expanded. If you recall, PPP forgiveness has to be funded predominantly by payroll cost, at least 60% to get full forgiveness. At least 60% of the good costs that you claim for forgiveness have to be for payroll, but you can also pay rent, interest, and utilities. In addition to that, we now have 4 more categories, and I'll say this, based upon what we've talked about previously, we've kind of been on a roller coaster relative to this, where in the beginning it was with 8 weeks to pay these costs and businesses partially or fully shut down. The question was, what different types of costs can we use for categories of good costs? And then as the program liberalized a bit and the period of time with which you could pay good cost expanded, we became a lot less concerned about these other good costs because it was just simpler. And in some ways, it was optimal from an optics standpoint to just fill your bucket with payroll good cost. So you may be wondering why we're spending some time on this. And again, we won't spend a lot of time on it, but based upon some things and some changes that Mark will talk about here in a minute, these other good costs may take on some increased importance, as there may be situations where it's in a business's best interest to use fewer payroll costs for purposes of forgiveness. So these new expenses or operations expenditures, think of these as business software or cloud computing services. Again, it can be for a variety of reasons, whether it's payroll, accounting, inventory, what have you. But again, think of it as business software or computing. Property damage costs, hopefully none of our clients have to deal with this, but based upon the civil unrest that occurred during 2020, any property damage, vandalism, or looting due to those disturbances that aren't already covered by insurance, those costs would be subject to PPP loan forgiveness. Costs paid to suppliers. Again, it has to be pursuant to a contractor order in most cases that was in effect prior to the covered period, i.e. prior to when you took out the loan. But if it relates to perishable goods, if those are the goods that are in question that we're talking about, those agreements or those contracts can be entered into during your forgiven covered period when you're counting good cost. So, but that again, that's another set of expenses that are potentially subject to PPP forgiveness. And then finally, worker protection expenditures. Think about PPE, personal protective equipment for employees, any other operating or capital expenditures that helped your business comply with Health and Human Services, CDC or OSHA, or other equivalent guidelines. In other words, to help you operate your business in a safe manner during the COVID pandemic. So again, payroll costs have to be at least 60%, but now we get rent, interest, utilities, operating software costs, property damage, supplies, and worker protection expenditures. And again, this isn't something that we would have spent a lot of time on previously, but it may make a difference for some clients, some businesses. They may have incentive now to look for these other non-payroll good costs. Now, again, these are retroactive, but the last bullet point we need to keep in mind is that, and you'll see this on some of these other items that we talk about, these retroactive changes do not apply to loans that were already forgiven prior to the effective date of this act. So if you've already had your PPP one loan forgiven, those loan forgiveness funds were dispersed by SBA, and that happened prior to or by December 27th, you can not go back and claim these extra costs if you needed them to fill your bucket. But again, in most instances, most businesses were able to use payroll cost at 100%. So hopefully that doesn't make a difference to a lot of clients. Moving on then, as it relates to these loans, we've had loan forgiveness for loans that were smaller than $50,000 or $50,000 and less. Those loans are subject basically to automatic forgiveness. Again, it's a very simplified process. We still didn't get automatic forgiveness necessarily for $150,000 or less, but we did get significantly simplified. And it's a one-page certification, again, according to the Act, and this form has not been released yet, but it is a no more than one-page certification. And so you just have to state the following. You have to provide the number of employees or estimated number of employees that you were able to retain due to the PPP loan proceeds. 2, you have to estimate how much of the PPP loan was spent on payroll, which is nice. We don't have to specifically identify employees and the wages associated with those employees. It makes a lot of the administration of this significantly more simple. What was the amount of your loan? Easy enough. And then you have to attest that you've provided the required certification, presumably at the beginning, with the necessity, all of the stuff that shows that you qualified for the loan, that you were going to use it for the right reasons. You have to certify that you complied with program requirements, you used the money for what it was supposed to be used for, and you will retain the records proving such. Okay? And if you do that, that's all you need for the loans for forgiveness as it relates to loans that are no greater than $150,000. Now that last bullet point's on there not necessarily to scare you, but just as a reminder that even with this simplified reporting, these loans, and it is mentioned in this act, are still subject to audit at the discretion of SBA. Again, we know SBA is going to automatically audit those loans that were greater than or equal to $2 million. And so there's no automatic audit necessarily associated with these. But again, it could be subject to audit even under the simplified forgiveness.
And Jeremy, this one was one where we were encouraging a lot of employers who took PPP money and had loan balances between 50 and 150,000 to just wait for it. And after months and months and months of waiting, December brought the change that we thought would come. And so those companies that borrowed in that range now get this simplified application that hopefully saves them a lot of work. All they had to do to get it was monitor the status of PPP for about 5 or 6 extra months.
Yeah, that's exactly right. You, for better or for worse, you had to stay on the roller coaster a little bit longer. But the benefit of that is that hopefully it makes the forgiveness process significantly less burdensome to you, which it should. And so any loan then, and Mark will talk about this a little bit further later on, but really there's not a lot of incentive to wait on forgiveness for loans that are less than 150,000 or up to 150,000, provided that what we're going to talk about next does not apply. Okay. And so this next retroactive change is probably one of the more important ones, and it will play into the forgiveness. It will play into the forgiveness as far as when you decide to do that. Because again, if you fall under one of these categories, there's probably not in your best interest to jump into forgiveness yet until you decide whether or not you want to top off your loan, for lack of a better word. So a lot of borrowers, if you're in a specific situation, you can request an increase in the loan amount, even though you're only supposed to be able to get one PPP1 loan and potentially up to one PPP2 loan. There are circumstances when you can go back and get your loan amount adjusted and maximized where maybe it wasn't before. First set of circumstances, if there was a borrower who returned all or part of their original PPP loan, they can reapply for a loan in an amount equal to the difference between the amount of the loan they actually kept and the maximum amount of the loan they could have received. If you remember, think back to this process. We've been on such a roller coaster ride related to this. This process, particularly the first draw loans, were meant to be relatively inclusive. They wanted to make the process easy. And that was fine until news stories started coming out regarding the types of businesses that took SBA's advice and actually got the loans. And suddenly there were some instances, particularly in the political realm, where people started having concerns about the borrowers that were taking the money. And so we had a lot of discussions with clients about whether or not they should or shouldn't keep the money, whether or not they met the necessity requirements. But even those businesses that met the necessity requirements in some circumstances decided, maybe for public relations purposes, or they decided they didn't want to keep the loan, or maybe they thought, we know it's a finite amount of money. There are other businesses that maybe need it more. We can ride it out. We're not going to take the money. Absolutely nothing wrong with that. But if they have a change of heart now, as these new funds open up, they can go back to the well and reapply for that PPP loan, assuming they still meet the necessity requirements. Secondly, if the borrower had a round one loan and they got into the process early, and we know this has happened, individuals got into the process early, businesses got into the process early because, again, it was a finite amount of money. And they knew it would run out, and it did. I think within 10 days, it was in less than 2 weeks, that initial round of PPP funds were gone. Okay? They got in, they got their loan, and the guidance continued to be issued by Treasury and SBA over the following weeks and following months. And in some instances, based upon that guidance, those businesses found out that they could have been eligible for a greater loan than what they received, but they just didn't know it at the time because they were working on the guidance they had at that time. In those circumstances, a borrower can go back and have their loan topped off to maximize the amount of loan up to what it should have been. Now, we don't necessarily have a mechanism, I think, in place for all of these yet, but SBA will be working with the banks to do that. But know that if you were shorted on the amount of the SBA loan based upon you didn't have all of the information available to you at the time because guidance was still forthcoming and the guidance hadn't been issued, you can go back and get an increased loan. In addition to that, farmers and ranchers, and we're going to talk about that here in about 2 minutes, farmers and ranchers got a really nice break in this new act that for most farmers will give them an increased loan, and in some instances make some farmers eligible for a loan where they weren't before. If they had a loan and were subject to an increase, they too can go back and have their loans maximized or topped off to that greater maximum amount. Here's the one big caveat related to all of this, though. If a business had a PPP loan that was already forgiven as of the effective date of this act, so if you had received a forgiveness determination, and by that, the forgiveness funds were dispersed by SBA as of December 27th, 2020, unfortunately, you are unable to go back to the well. Any other circumstance, assuming that's not the case, you can go back and have your loan topped off. So looking at that, then let's look at the farmers and ranchers in particular. Again, this is something I think that's going to impact a lot of our clients. This applies to self-employed farmers and ranchers. So unfortunately, if you have someone that has a farming operation through an LLC, taxed as a partnership, it's not a single member LLC, or it's through any entity, they're not going to qualify. But if you have a farmer or rancher who was a sole proprietor, independent contractor, or otherwise an eligible self-employed individual, And by that, they report their farm income and expenses directly on a Schedule F, again, not through an entity tax return. And they were in business as of February 15th. As of February 15th, again, we're going to see that's for everybody that gets a PPP loan. If you meet those requirements, you are subject to these provisions. And so what they've done then with this act is they've said an eligible farmer can base his or her maximum PPP loan amount on gross income. Okay, and that can be 20, if we're talking about existing loans, gross income in 2019. Now that's subject to the $100,000 limit. Again, if you recall, you can count no more than $100,000 of compensation for any employee, but you can still use the gross amount versus net income. If you have employees, you can add that on top of the amount of the PPP loan that you received related to the wages you pay for your employees. The only catch there is you take your gross income, you subtract from that the amount of wages paid to the employees because they don't want you to double count those, and then subject that self-employment, gross receipts number to the $100,000 limit. And you get that on top of the loan you received before. So what this means is, again, almost every farmer, even those that had employees, are going to be subject to a larger loan than what they thought, again, since they're able to do it on gross as opposed to net, unless their net income was greater than 100,000. And those farmers that actually had net losses in 2019 can now go to the table and receive a PPP loan based upon their gross income for 2019. Oh, and one clarification, I noticed something's come in on the chat related to the prior slide where we talked about the effective date. I think the slide said on December 27th. The implication on that is it's on or before. It's as of the effective date. So anyone that's had a PPP loan forgiven as of or no later than December 27th, those are ones that are not subject to some of these, not subject to being able to go back for the increase, for example.
And Jeremy,
I just wanted to clarify that.
I might just note that the 27th, if you remember, was a Sunday. He signed it, I think, at around 7 or 8 p.m. Eastern time on Sunday. And so I don't think there were a lot of loans that were actually forgiven on the 26th or the 27th for that matter.
Yeah, good point. So, but again, that's sort of, it's a cutoff date. So moving on then from farmers and ranchers, we're just going to hit a few of these other clarifications. As I mentioned, the Act explicitly states that that a business had to be in operation on February 15th, 2020. Otherwise, if you were not in operation at that date, you're no longer eligible for a PPP loan, either round 1 or round 2. This next one is a big one. Those idle advances, which were up to $10,000 per business. Originally, whenever you made the application for forgiveness, you had to reduce the amount of forgiveness by the $10,000 idle advance. That is no longer the case. You get PPP forgiveness on the full amount, and it is not reduced by that $10,000 advance. And so those that have already been to the well as it relates to forgiveness and have received forgiveness determinations, there will be a procedure that's put into place to allow you to receive that additional idle advance that you paid back as part of the PPP loan process. So again, that's something that's nice and something that I'd say impacted almost all of most individuals that receive PPP loans, it seems, also receive the idle advance. And so that's something that's going to be very beneficial to them. Third bullet point, as you recall, payroll costs also included healthcare, premiums paid on behalf of employees by employers. The Act expands that to include life, disability, vision, dental, paid on behalf of employees. And then finally, only 10 months too late, we finally received the definition of seasonal employer. And so again, I joke that it's 10 months too late because the original concern about that was that if you were a seasonal employer, it would change the baseline period that you used to determine whether or not you had a reduction in employees. And that became a lot less important once this provision was extended out to 24 weeks as it relates to forgiveness. Having said that, though, this isn't inconsequential now to know who actually qualifies for that, because if you qualify as a seasonal employer, that also impacted the baseline period you used to calculate the maximum loan. Again, what 12 weeks you use to calculate your maximum loan. And so therefore, if you now see that you're a seasonal employer, all joking aside, it may be worth rerunning that to see whether or not you left some PPP loan money on the table and then utilize the topping up that we talked about just a slide or two ago. So again, something to keep in mind on that. We finally have an explicit definition of who a seasonal employer is. So
Jeremy, we had a quick question come in on the farmers, if we might just pause here at this transition. And the question was, if they're going back and topping off their loan or getting a loan where they, let's take a farmer that reported a net loss in 2019. So they were prevented from accessing PPP programs previously. Now they can. The question was, is that a round one loan or a round two loan?
It would be around, if you're topping off, we're talking round one. And so if you went back and topped off the loan, that's just a continuation of PPP 1. And we'll see that that is important for another reason. It's implicitly that way, as we see with another rule, we'll see related to a rule with PPP 2. So it is deemed to be a round one loan. In addition, if a farmer was unable to receive a PPP loan because they had a net loss and now go back, again, by definition, if they have not received a PPP loan before, that is deemed to be a first draw or PPP 1. And so again, assuming they then use those PPP 1 funds, they go back, they receive an original loan, they use all the funds, and all of the funds are still available. There's still money in the federal coffers, set aside for PPP, and they meet we meet all the requirements of PPP 2, which we'll talk about here, a little bit later in the presentation. They can get a second loan. Again, there's a lot that has to happen from a timing standpoint for that to work, but these are deemed to be first round loans. Another question's come in regarding topping off. So since the definition of the maximum loan amount has changed, since has the definition of maximum loan amount changed since the types of good costs have been expanded? The maximum PPP loan amount is predominantly unchanged. As it relates to those loans, it's still, as it relates to first draw loans, it's still, generally speaking, in most instances, the 2.5 times your average monthly payroll cost. So they've not expanded the general definition of it, but there have been some tweaks, that would allow you to go back and get a larger loan. But generally speaking, the maximum PPP loan amount is still largely unchanged. Okay, so moving along then. So that was all retroactive changes. Okay. In addition, there are prospective changes to the PPP. And again, when we say prospective, this still involves round one loans and round two loans. So the biggest change is that as of this week, the loan application process is reopened for both first and second draw. Now, as of right now, these loans are only being administered by community banks that typically serve underserved businesses, generally women-owned or minority-owned businesses, both first and second draw. Those community banks that deal with those businesses generally are the ones that are going to get first crack at this, and then the process is going to open up later on to everybody. But the process is reopened on a rollout, and it's open through March 31st, 2021, or until the $284 billion set aside for it runs out. If you are a new borrower, and that includes the farmers and ranchers that were subject to those new rules, you can choose to use either 2020 or 2019 calendar year as the base period for calculating the maximum loan amount. Now, to the question before, again, it's still generally the same calculation of 2.5 times generally, but you do get the option to use 2020 or 2019 calendar year. In addition, they do provide flexibility to say if you're not self-employed, you can also use a precise 1-year period immediately before the loan. But since we're in January of 2021, for all of those loans that are occurring in January 2021, that's going to be calendar year 2020. And we think a lot of individuals likely will use that calendar year even as it goes forward, likely from ease of administration. The covered period, that was something, again, that was originally 8 weeks and it got expanded to 24. And that's the period of time with which you have to pay good cost. That covered period can now be any period of time between 8 weeks and 24 weeks. So you can choose. This is important in those situations. If you have a business that qualifies for full forgiveness after 10 weeks and then has to have layoffs, that would potentially harm full forgiveness in week 11. Okay, you can now set your covered period to be 10 weeks, fill the application for forgiveness out using that 10-week period and move on. Finally, they did expand the universe of entities eligible for PPP loans. Probably the one we've seen most are 501c6s. You know, that's been talked about quite a bit, and destination marketing organizations. Now, their employee requirements are different. Even for PPP-1 loans, they can have no more than 300 employees. And they also are not allowed to have lobbying that exceeds certain levels. Again, they really don't want these going to lobbying activities or lobbying businesses. So no more than 50% of your gross receipts can be from lobbying. No more than 15% of your activities can be from lobbying, and I don't believe that's been defined. No more than $1 million in lobbying costs can be expended by the entity during the most recent tax year before February 15th of 2020. Housing cooperatives with no more than 300 employees and certain news organizations are also allowed to go and get a PPP loan going forward. And again, that could be first or second draw. Entities not eligible to receive PPP loans, businesses that have permanently closed. And again, they make the distinction between businesses that are suffering from or undergoing a temporary closure. Those are fine. Businesses that have permanently closed, that's not okay. Now, what about businesses that have permanently closed, but for the ability to go back and receive another PPP loan? Hard to say. There's a little bit of ambiguity there. But again, generally speaking, if your business is permanently closed, you're not eligible for a loan. As we see later on, businesses in bankruptcy are also not eligible. Businesses not in operation February 15th of 2020, we talked about that. There's another aid program for live entertainment venues or talent managers and museums. The shuttered venue operator grants, I believe there's $15 billion set aside for this. So honestly, I don't know how long it's going to last. But if you are eligible for that and receive the shuttered venue operating grant, you are not eligible to receive a PPP loan on a going forward basis. If you've already received one, that's okay, but you can't receive a PPP 1 or 2 loan after the effective date of this bill and received a shuttered venue operator grant. Publicly traded businesses, we know those aren't cool. They don't want those getting a PPP loan. And then there are a handful of businesses that are ineligible for PPP 2 loans, but not explicitly ineligible for PPP 1. And probably the one that's of most interest would be lobbying organizations. So again, they've tried to sort of button up the program a little bit and try to really narrow down and specify who can and cannot receive these loans. So those are the changes. That is a lot of information related to PPP, and we haven't even gotten to the second round. But again, know that prospective and retroactive and prospective changes, again, as we've talked about, generally apply to both programs. Mark now is going to talk about the other big program that was changed. Again, it didn't seem big before, but it's taken on a significantly greater importance now, potentially, given new interactions it has with a PPP loan. So with that, I'm going to turn it over to Mark to discuss the employee retention credit.
Thanks, Jeremy. Before we fully exit round 1 PPP, looking back and looking forward, a couple of notes that have come in on the chat. One was a question on accounting for gross receipts, and we're going to talk about gross receipts in a second. So I'm going to have Richard stick a pin in that question for the time being. And then another comment that came in, and I think that's important to help frame the discussion we're having here, is we have a batch of rushed rule changes that came in December 27th. The SBA has been scrambling for the past 2 weeks to try to interpret and implement those and get something that's administratable up and running in January. And so the comment that came in was that in the last 2 weeks, the SBA came out with some interim final rules, IFRs, that try to implement what it is that the SBA thinks that Congress intended. And in those rules, there's some language that makes it sound like the ability to go back to the well and fill up and top off your loan proceeds might be more limited than our slides probably suggested. And so, take everything in this presentation with the grain of salt from the perspective of this is the information that we know at the current moment, but it is ever changing, quickly changing. You know, Friday evening, we got some updated forms from the SBA. So this continues to evolve. So what we want these prompts to do is to be things that start a discussion within your business, with your lender, with your accountant, as a group, and to help make sure that no opportunities pass you by. If we chase one of these opportunities and we hit some dead ends, we'd rather do that than not chase it. So
absolutely. And if I could just interject one point, I think there may be on that comment on the second question here in the Q&A, I think there may be, I think one, your point is well taken, that we're going to do what we can to try to best benefit those individuals that could be subject to this. And if we hit a roadblock, we hit a roadblock based upon future guidance. But I think there may be a little bit of a connection maybe, or confusion between the different reasons for the increase. So I think my hope is that the language that is quoted there related to being able to go back if you did not accept the original loan that was approved, you can go back. And I agree, the language on that is related to the amount that was approved. But the IFRs, particularly the 120 pages worth that were issued, here within the last weekend on top of the bill, seems to allow for an increase because you should have been approved for more, but were not, because you didn't have the benefit of having all of the guidance. You applied for the loan prior to all guidance was issued, and so therefore, seemingly, you should be able to go back and receive a larger PPP loan, regardless of what you were originally approved for, because the rules changed on us. So I think there may be a little bit of a confusion on that. But again, as Mark rightly said, we're still seeing additional guidance. And again, to that point, 120 pages plus worth of guidance that was dropped on Friday night related to this new act, and more guidance that will be forthcoming within the subsequent days and weeks.
All right, now we're ready for ERC. So let's tackle it. A lot of these definitions and rules have been around for 8 months or so, and we talked about them in some of our earlier presentations and set them aside because the ERC was an alternative to PPP loans. So for everyone who said getting 100% of my payroll funded is better than getting 50% of my payroll funded, you made a great decision and you didn't need to care about the ERC. The ERC also only applied, and this remains true for 2020, the ERC only applied, as we'll see, to businesses that suffered what I'm going to call a severe reduction in gross receipts. And we'll look at that here in a second. So here's the rule change. Congress in December said, oh man, this pandemic has gone on longer than we thought. Let's give businesses that suffered a severe downturn in gross receipts the opportunity to double dip. And we'll see in a second, they're not double dipping on the same costs, but they're going to participate in both programs for the same calendar year or quarter as a possibility. And again, for this ERC is going to apply to a subset of you on the calls, certainly not everybody who's on the call. But if it does apply, it introduces some new factors that affect how we approach the PPP forgiveness question. And so we want to make sure we have our arms around A, whether it applies to you, and B, if so, what do you need to do about it? So the people who might be able to get both are businesses, and that definition is defined broadly and also includes some nonprofits that had either fully or partially suspended operations as a result of what I'm going to call a shutdown order, a government order limiting commerce, travel, or group meetings, or So for non-essential businesses, that was relatively prevalent, but for a short period of time. For other businesses, we're going to be looking for those businesses that suffered a severe reduction in income, and that's defined as a more than 50% reduction in quarterly gross receipts when compared to the same quarter of 2019. We'll see an example of that here in a few minutes. And we had to pay wages. Jen, if you could go back once more, there you go. And then the bottom part of that slide, we had to pay wages, and we are going to fit in either of two buckets. Either we had a 2019 FTE count less than or equal to 100 employees, or we didn't. We were larger than that. We had more FTEs. And the rules here create a cliff. And what I mean by a cliff is a slight change in facts produces a severe change in result. So the slight change in fact is I'm a business owner and I have 99 FTEs in 2019. When I'm looking at my ability to participate in the employee retention credit, I get to count every single employee, even if they are busier now than they've ever been. That particular employee, again, the overall business entity needs to be subject to a reduction in gross receipts. But even fully engaged employees count for purposes of the ERC calculation. When I add 1.01 FTEs to it and I cross that 100 FTE barrier in 2019, again, we're looking to history to define these numbers. Then we find ourselves in a world where we only get to count wages paid to what I call idle employees, IDLE, not EIDL, idle employees who are being paid not to work. So again, that's an important distinction, an important cliff. And so for everything we talk about on the ERC, this presentation, the people who should get most excited about it are what I'm going to call small employers, less than or equal to 100 FTEs measured in 2019. All right, Jen, with that, let's advance to the next slide. And let's talk about what it actually gets you. So in 2020, if we're claiming it for a period in 2020, you get half of your eligible wages, but that's capped for the year at $5,000 per employee. The credit is capped at $5,000. The wages are capped at $10,000. 10,000 times 50% gives us the $5,000 max. And we'll see here in a second that businesses can potentially claim it for multiple quarters. And we're going to, once you hit the per employee cap, then you're done counting. It doesn't matter if you've paid that person more in subsequent eligible quarters. Again, here, this bullet point on the interaction with the PPP is key. If you're a business that suffered a more than 50% reduction in gross receipts in 2020, your ability to claim both the ERC and the PPP is preserved, is awarded as a result of the December Act, but you can't count the same dollars twice. So I can't take the same June 10th payroll and count the same dollars that I pay to Steve for both purposes, okay? So that creates some complexity in terms of measuring the interaction and making sure that we're using these responsibly. Again, the eligible wages are compensation that's paid during the shutdown period or compensation paid during a quarter where the gross receipts drop by more than 50%. And here's the important part of this bullet point. And each following quarter until gross receipts are restored to at least 80% of 2019 levels. So in plain English, that means that your gross receipts dropped, let's say in Q2 of 2020, they were 40% of what they had been in the prior year. And let's say in Q3, they rebound to 75% of what they had been in Q3 2019. Q3 is still a good quarter. You still get to count it. Okay, so we're talking about retroactive changes, looking backwards to things that have already happened. We're here January 2021. It's a new year. And so I've covered the point that this is going to be most exciting for those who have a 2019 FTE count under 100. And we're going to talk about potential retroactive ERC benefits because, of course, when you rush a bill through that's 5,500 pages, there are some things that might not be as clear as we would like. And so let's advance to the next slide and we'll talk about some of the things that are giving us a little bit of pause before we start jumping up and down too much on this issue. So I guess the first thing before we look at that is let's talk a little just briefly about gross receipts. You'll see that for PPP Round 2 in a second, we're going to have a reduction of gross receipts test. For the retroactive ERC, we have a reduction in gross receipts test. For they're going to have slightly different definitions and maybe a little bit more flexibility on the PPP definition. But for ERC purposes, we're asking, using the accounting method that you use for federal income tax purposes generally, let's look at what your gross receipts are. And just as a couple of reminders, that's total sales, no reduction for cost of goods. If you're a service provider, that's everything you get. We're not subtracting out any wages of folks. But if you sold a capital asset in the year, we're not talking about gross proceeds. So if I had, $1 million building that I sold for $1 million, that's not gross receipts. We'd look at the net gain from that to think about gross receipts here. So again, repayment of loans, repayment of principal, that's not gross receipts, even though it's a positive cash inflow. Couple of reminders there, but that's what we're talking about in gross receipts. For anyone who's close to the line, I think it makes sense to have a discussion and make sure that you're comfortable and we're comfortable that whichever side of the line we think we're on, that we dot our I's, cross our T's, and nail down whether we are where we think we are from a gross receipts basis. Okay, now I'm going to jump to the next slide and look at this word potential that I have in all caps. So here's our technical hiccup. The ERC provision that allows employers generally to go back and claim the ERC retroactively, again, not on the same cost that supported a PPP forgiveness application, but on other costs that were paid or incurred in 2020. There's a cross-reference that's not exactly what I think Congress intended, but it's hard to know exactly what the intent was when all you have is the words on the page. So I'm going to describe two views. View 1 is what I think they intended. View 2 is a view that will cause us to delete this slide set from future presentations in all likelihood. So let's go through those. View 1 says, if you were subject to a shutdown order or had more than 50% reduction in quarterly sales, you can go back and claim the ERC up to $5,000 per employee retroactively in full. That's what I think Congress wanted to do. I'm not sure they got the job done. So if we get guidance that says that's exactly where we're going to be, then the ERC is going to be a big deal for those businesses that were really hard hit by the coronavirus. View number 2 says Congress wrote down on the page what it intended to write down. And when it reordered all these provisions, it was moving text from, paragraph B to paragraph C. And there's a cross-reference in there on these retroactive credit claims that refers to what costs are eligible. And the subparagraph that is referenced refers only to healthcare costs. The idea, Jeremy alluded to it in PPP land. For ERC, they said, wait a second, if an employer is paying for the healthcare costs of its people, then we want to count that as eligible wages. And I think by mistake, but this is what the bill says, they cross-reference this healthcare cost language only. And so we have this ambiguity that's described here on the slide. So in our examples going forward, generally, for brevity, we're going to try to talk about it in terms of view one, the rosier view, and hope that we get either some technical correction bill or some favorable guidance from Treasury saying when they said healthcare costs that's not what they meant. They meant all of our wages. Okay. I have a quick example queued up here. We have a more comprehensive example, and as we predicted at the outset, time is evaporating quickly. So I'm going to bypass this example. It's going to be there in the slides that are available for download when we break. And let's turn, Jeremy, and think about where we are now that we've reviewed the changes to the ERC in our rearview mirror and the changes to PPP.
Yeah, thank you, Mark. So if we look at this, let me, I guess first, before we get to that, before we completely move on, I do want to answer this question on here related to, from Peters, and I'm assuming Peters talking about from the PPP standpoint, I believe, and if it's related to the ERC, correct me, but whether, as we look at comparison purposes for, since you mentioned the February 15th date, I'm assuming this is for PPP2, we will talk about that here in a minute. So I just will let you know that, yeah, generally speaking, there are provisions that if you were not in business for the full amount of the year, there are provisions, and it basically does what you say there, where you get to pick and choose. So as we look at this and think about where we want to go going forward, we've kind of run the gamut, right, as it relates to the forgiveness process. At the beginning, you know, we were hurrying up to try to fill the bucket with good cost, and then we were ready to apply for forgiveness, and there were various reasons why we said, you know what, there may be reasons to pump the brakes on that. Let's hold back on applying for forgiveness because we don't know about deductibility, or your loan may not be 150,000. You know, maybe less than that. You may be subject to, you know, automatic forgiveness, or in this case, simplified forgiveness. And then we received guidance that said, okay, these loans are deductible. Great, we can check that reason for delaying off the list. And then we said, okay, we received simplified forgiveness where we really don't have to specify a lot of the specific costs for loans that are no greater than $150,000. Fine, let's move that off the list. And so really the incentive for most borrowers at that point was there's no reason to necessarily wait on forgiveness because most of these unanswered questions were answered. And then as they continue to provide us answers and more provisions, we now have new questions. So here's where we're at as it relates to the forgiveness process. If you could have topped off your loan, and you could have borrowed more in round one, then you're going to want to make that decision about whether you do that before asking for round one forgiveness. Okay. If you submitted the loan forgiveness payment, if the SBA remitted the payment to the lender on or before December 27th, and again, you know, that was a weekend, so prior to December 27th, the business is unable to go back to ask for more. So in which case, we can take that decision point out of the equation. But if that's not the case, if you've not applied for forgiveness, did not receive a forgiveness determination by that date, you need to decide if you're eligible to top off the round one loan, whether you want to do so or not. And if you do, then you wouldn't want to proceed with forgiveness. If you borrowed the correct amount in round one or just decide it's not worth going back to the well for, if you're under the 150, you have the simplified application, which we haven't seen yet, but again, a simplified no more than one-page certification, and you can move forward with forgiveness without actually having to explicitly list specific payroll or match payroll to specific employees as it relates to what you have to count on the PPP loan application. In that case, what we talked about really doesn't impact you. Okay? So in those instances, you're okay to proceed with forgiveness. However, for borrowers with loans that are over the 150,000, so they're not subject to the simplified reporting, they weren't subject to a long shutdown, and they had relatively stable revenue, they're not going to meet that more than 50% reduction, you know, quarter by quarter, then they can go ahead and file on the form, on one of the regular forms, not one of these simplified, but the easy form, or on the full form, whichever one applies. So in those instances, nothing really stopping you from doing it. Finally, though, for those businesses that had loans that were greater than 150,000 but had a downturn in gross receipts that were significant, you likely want to wait until you get some answers about the interaction between the ERC and the PPP before you go filing for forgiveness. Because if you do take the time to look at that example that Mark provides, that we provided in that preceding slide, there are some really significant dollars that could be on the line depending upon number of employees you have, and assuming you don't go over that 100 employee max, there could be some real dollars on the table if you go back and do this. So again, here are on this slide, the instances where it makes sense to go ahead and apply, and those instances where it makes sense to go ahead and wait. So moving then on to PPP Round 2. And again, the good news is, as it relates to PPP Round 2, a lot of the rules that apply to Round 1 are also going to apply to Round 2. But again, these are the second draw loans. So the whole point behind these are SBA's wanting to get money to those businesses that absolutely need it the most. They're going to get them a second run at PPP. So you can tell they try to narrow the focus or narrow the universe of businesses that are eligible. First and foremost, you have to have no more than 300 employees. That's down from 500, again, trying to get smaller businesses. Now, if you're a restaurant or a hotel and a certain news organizations, and you have multiple locations, you get 300 employees per physical location. It's not 300 employees overall. So small business, you had to show a reduction in gross receipts. And this gets, I think, hopefully to Peter's question. You had gross receipts during any calendar quarter of 2020 that were at least 25% less than the gross receipts for the equivalent quarter of 2019. However, they recognize you may have a business that was in existence in the appropriate time. It was in existence and operating on February 15th, but wasn't in business for all of 2019. So if your business was not operating for at least the first 2 quarters of 2019, you can pick and choose. You can take any of the quarters in 2020 and compare them to any of the quarters in which you were operating in 2019 as it relates to calculating the reduction. If you weren't in business at all in 2019, but were in operation by February 15th, then you compare quarters, either quarter 2, quarter 3, or quarter 4 of 2020 to the first quarter of 2020 as you look for that 25% reduction. Finally, if you had a business that was operating for the whole year and you can show a more than 25% reduction or at least a 25% reduction for the entire year, then they will allow you to use that annual, because obviously you had to have at least 1 quarter. That will make things easier administratively. In that case, you can just provide, for example, annual tax returns for 2020 and annual tax returns for 2019, and you don't have to provide the quarterly statements. So eligible entities have to be smaller entities, have to show a reduction in business or a reduction in gross receipts. And in addition to that, they had to have used their first round PPP loan. They had to have spent all of it on eligible expenses. So if your business got it and didn't pay payroll but bought a Lamborghini, you're out of luck. They're not going to let you go back to the well. But if you paid all of those expenses, if you paid all of those funds or expended them on eligible expenses on or before the expected date on which the PPP Round 2 loan is dispersed, then you can get the loan. So even if you've not expended all the funds now, as long as you will do so before you get that second loan, you're fine. As it relates to gross receipts, we've had questions related to this. Mark talked about it a little bit as it relates to the ERC, and a lot of those issues relate to the PPP too. Gross receipts are generally income from all sources: sales of products or services, interest, dividends, rent, royalties, fees, and commissions. Okay? And again, it's generally based upon the basis of accounting you use, but they haven't clarified what to do in those situations where maybe the basis of accounting you use for income tax purposes is different than the basis of accounting you use for the financial statements. The instructions would suggest we would look at the basis of accounting you use for income tax filings, but I wouldn't necessarily shut the door on being able to use a book basis method if it differs from your income tax basis. So again, just something to keep in mind. If you're a not-for-profit, the gross receipts, they say, are as defined in IRC section 6033, and I would say related regulations. Simply look for program service revenue. That's generally speaking the revenue, the gross revenue that you would look at for purposes of not-for-profits. And then finally, as you talk about gross receipts, those are reduced by any returns and allowances as we look at calculating those. Moving on to the next slide then, what do gross receipts not include? Well, the good news is forgiven PPP-1 loan proceeds, even though those, once it's forgiven, will hit gross revenue for book purposes, even if it's not taxable, they are not going to punish you for that. You do not have to include those forgiven PPP-1 loans. Capital gains and losses, not included. Any sales tax that you have in gross receipts that are to be remitted, to the state tax or local taxing authorities, any sales taxes, again, you're not going to hold on to those. You're going to remit those. Those aren't included in gross receipts. Assuming they're included in your gross receipts number, you take them out. Intercompany transactions between businesses and affiliates, they don't want you gaming the system, by adjusting those. Those do not count. And then finally, in any circumstance where you're acting more like a conduit, you're kind of the intermediary collecting the fees to be remitted to another. In those circumstances, you do not calculate those as gross receipts. So what is the maximum loan amount? As we talked about, generally speaking, the rules are the same, but there are exceptions because that's just the way this rolls. There are always exceptions. Generally speaking, the maximum loan amount's a lesser of 2.5 times your average monthly payroll. You can use either 2019 or 2020. If these continue further, and if people keep applying for these in February and March of 2021, you could also use the prior 12 months, exact 12 months if you're not self-employed. But generally, most people are going to use 2019 or 2020. If you use 2019, then that also does reduce the amount of paperwork that you would have to provide because the bank, assuming you go back to the same lender, they have all of that documentation for your first loan. But again, you're going to want to do whatever is most beneficial to you as a business. Now, here's a change. It's generally 2.5 months of average monthly payroll or $2 million, the lesser of those two. So they've capped these at $2 million versus the original $10 million max on the first round PPP loans. If you're a seasonal employer, you get to use, if you calculate average monthly payroll, you're looking at any 12-week period between February 15th of 19 and 20. So again, pay attention to that. If you go back to that previous slide, look to see whether you qualify as a seasonal employer. And if you do, go ahead and see if it makes sense to look at these 12 weeks. If you didn't exist if you didn't exist for a full year prior to February 15th, but you were in operation on February 15th, you calculate the averages of the months you were in existence. And then finally, though, here's one of the significant changes. If you're in what they call like an accommodations industry, restaurants or hotels with NAICS codes beginning in 72, your maximum loan amount is actually used as a 3.5 times multiplier, not 2.5 times. So if you're a restaurant or a hotel that got a PPP-1 loan, and now you go back for a round 2 because you qualify, even if you use the 2019 payroll, the exact same payroll you used for that first loan, you're going to get a larger loan up to the $2 million, of course, based upon the fact you get to use a 3.5 times multiplier and not the 2.5 times. So that's it for PPP2 prospectively, both prospectively and as it relates to round 2. Mark, now I'm going to turn it back over to Mark because in addition to what we saw retroactively related to the ERC, which causes all sorts of potentially, well, it causes complicating and in some instances, hopefully good interactions for businesses between the ERC and the PPP, they've also expanded the employee retention credit into 2021 with some changes to liberalize that program as well. So with that, I'm going to turn it back over to Mark.
Thanks, Jeremy. We got a few questions that have trickled in on PPP. I'm going to move forward with the ERC because it'll be somewhat brief, and then I think we can tackle some of the lingering questions here in a couple of minutes. So, new ERC is one slide, but it probably understates its significance if you were looking at just the totality of this presentation and what's important. One slide would not do it justice. So you'll recall that the retroactive employee retention credit required a significant reduction in quarterly gross receipts of more than 50%. For 2021, a business that suffered a more than 20% reduction is going to get access to the employee retention credit. And again, we're going to compare back to the same base year as we did for the 2020 credit. We're going to look all the way back pre-pandemic to 2019 in most cases. So they've made the ERC easier to get into for Q1 and Q2 of 2021. They've also made it more valuable. Before, we capped eligible wages at $10,000, multiplied that by a 50% credit, and got a $5,000 per employee cap for the year. For 2021, we are going to get to take a $7,000 per quarter credit. And as the law currently stands, the program is approved through Q2 of 2021. And so we're looking at a $14,000 per employee credit to help defray the cost of keeping employees employed. And for businesses that had 2019 FTEs below 101, less than or equal to 100, then we get to claim eligible wages on all of our people, as long as we're not double dipping the same cost for PPP rounds 1 or 2. So the same payroll to Steve, you can't count for both programs. But if you paid Steve $10,000 that you didn't count in a PPP application, then you've maxed him out for the quarter and he gets the $7,000 credit. Okay, I want to turn to a comprehensive example. And there's a lot on these slides, and this example is going to span several slides. I don't want our listeners to agonize over the details right now. These slides will be available for download, and you can study this example on your own, especially if it relates to a situation your particular business is in. But what we've done here in this comprehensive example is looked at a situation where an employer might have been really hard hit by coronavirus, and to try to look at the totality of the programs that have been put in place, PPP and employee retention credit being the key two that we're focusing on in this example, to see where do they land after the government aid to help them weather this storm. So I'm going to assume level FTE count in 19, 20, and 21 of around 80. 80 is a good number. 80 means that we're under 100, which means when we're calculating the ERC, we're going to count all our employees, not just our employees who are being paid to do nothing. Okay, so if you look on the left side of this slide, you'll see the key financial figures. If you jump to the bottom line, you'll see over 2019, it was an almost $6 million firm, gross revenue. In the pandemic year, that shrunk by 32% to $4 million. Okay, so that they had a significant revenue decline. So applying the ERC on a standalone basis will say, look, it seems like we might be ERC eligible. Let's look at that. It seems like we are going to be PPP Round 2 eligible. Let's look at that. I'm going to assume for this example that the company continued to pay its people. We're going to see that they took a $600,000 PPP loan, but they could have borrowed $650,000. And this was a demand-driven drop. They weren't ordered to close. The demand for their product was not as high in 2020 as it was in 2019. And the company kept everyone's pay the same and said, let's try to weather this storm here together. So if we'll advance to the next slide, let's look at what happens in 2020. What are the decision points for this company? First, let's jump to the far right column and think about the employee retention credit. Under the old rules, we took a PPP loan. We didn't even have to think about the ERC. Under the new rules, we need to look at whether we had a more than 50% revenue decline in any particular quarter. In quarter Q3 of 2020, we had a more than 50% revenue decline. So Q3 became ERC eligible. Q4 was not down 50%, but it was down more than 20%. So because it followed a quarter where we had a 50% revenue decline, we're also eligible for Q4. So on what cost? This is the question where we got to stick a pin in it. We would like to give you an answer. We can't right now. But there's a big potential benefit that's out there. So just based on kind of the rough parameters we presented on the first slide, we'd expect potentially $400,000 of ERC credit floating around out there that we might be able to claim for Q3 and Q4. That is, it's hard to overstate how huge that is for a $6 million company. If view 2 prevails, then all of our excitement gets killed, and we just basically draw a big X through ERC and said, thanks, Congress, but no thanks. You changed the rules. There's not much of a benefit. Maybe we'll go back and quantify what our healthcare costs were in Q3 and Q4, but we're going to move on. So I'm overstating it here for an exaggerative effect, but I say almost no benefit. There's a benefit there. It's just not a $400,000 benefit. Okay, let's jump to the far left column. I'm sorry, same slide. There we go. The left column there, what's happening? Okay, so we took a $600,000 loan. I just fed to the group that we could have taken $650,000. So the first thing we need to do before we request forgiveness is think about whether we want to try to get a larger loan. Again, many of the rules of which are still being sorted out. We have a call with some of our friends in the banking community. If you're on this call but aren't sure what I'm talking about, please reach out to us after the presentation. If you're in the banking industry, we'd love to have you on Friday, and we're going to talk through some of these revenue questions and some of the how do we and can we do it and some of those questions with our friends in the banking community on Friday. But we have a question to encounter of whether we want to go back and ask for more round one money. We've provided the PPP loan was large, more than 150,000. So we're not going to be able to file on the forthcoming short form that we haven't seen yet. And so we're going to be filing either on the full form where we have to provide complete payroll information and all the facts, or on the easy form. And the difference is going to be whether we had a reduction in business activity as a result of our compliance with directives from OSHA, CDC, HHS. I told you we were an essential employer. We were not subject to a shutdown order, but maybe we can meet that business activity standard nonetheless and get on the easy form. So we have a question. Do we want to wait to apply for PPP forgiveness? Because everything Jeremy and I were telling you this fall was, let's try to get our PPP applications to be wages, payroll only PPP applications to keep it simple. Now we have to choose between using our wages for PPP and maybe the ERC. And so we have a question to consider. Are we going to use up wage dollars on a PPP application that we would rather have available for a Q3 ERC retroactive filing if we get a favorable endorsement of view 1? So a lot to digest there, and that's just 2020, but wait, there's more. And Jen, if we can go to the next slide, let's think about 2021. So 2021, I'm going to start in the far right column again, the employee retention credit. We say it qualifies. You say, Mark, look back. We had exactly a 20% reduction, and I thought you said it needed to be a more than 20% reduction, and we did. But there's a special rule for Q1 2021 that lets us elect to compare Q4 2020 again to Q4 2019. And when we do that, we find, holy cow, we had a revenue reduction of more than 20% in Q4. So magically with this election, we're eligible for the employee retention credit in Q1 2021, even though we managed to hit the revenue reduction for Q1 exactly on the 20% cliff threshold. And look at this bottom line. The credit could be in excess of $500,000 for our 80-person firm. So these are meaningful numbers for these businesses that are trying to stay afloat. As we look forward to Q2 2021, we think that we're going to qualify. Our reduction in Q2 is more than 20%, so we think that that works. The thing that is causing us to say we think versus we know is, recall we made the election to get into the ERC for Q1 by looking back at a quarter in arrears. If that's an irrevocable election and we're forced to do the same thing in Q1, then all we've done is accelerated the credit, and our Q1 2021 disqualification comes to find us in the second quarter. That's not how we think it works. We think that the Q1 election stands on its own and then evaporates into thin air, and then Q2 is tested on its own and could make its own separate election, or could be tested based on the facts. So we think based on what we know now, we think there's maybe another $500,000 out there. PPP is easy. 2020 cumulative gross revenue that's going to go on a tax return was down 32%. That's more than 25%. So we're into round 2. Get our applications and our information together now. Be ready for next week. And if we were a restaurant, hotel, or fit into that genre, then we would be looking at almost a $900,000 loan. Otherwise, we're expecting it to be about the same that we qualified before, $650,000. So if we can advance to the next slide, we'll stitch all this together and look at what happened for our hypothetical company. We were down over 6 quarters, 2.4 million gross revenue. Ouch. But the government came to our aid. We got the ERC potentially in arrears. $400,000 hanging out there. We got the ERC for 2021, first 2 quarters, we think. That's $1 million. We got PPP Round 1, $650,000. We're a non-hospitality business, let's assume. So let's say PPP Round 2 is another $650,000. And so we're looking at somewhere between $2.3 and $2.7 million of federal government support to help keep this business afloat. We run the math and stitch it all together. If you look in that bottom right corner, you see that whether we get back to 0 or not depends on what happened with which of the 2 ERC views retroactively prevails. But we're coming really close to filling this $2.4 million revenue gap with government aid. Now, we've referenced a couple of cliffs in here, and we have a cliff at 100 FTEs. So if our firm was the exact same firm, but instead of 80 FTEs in 2019, we had 101, everything in the ERC column or row on this exhibit washes out. We just lost over $1 million of credit benefit there. Similarly, if we had missed any of these arbitrary 20% cutoffs, 25% cutoffs, 50% cutoffs by $1, we get the benefits limited. So again, there are cliffs baked into this, and for firms that are close to these arbitrary thresholds, it's worth a look to make sure that there's not an argument that you've got something in gross revenue that shouldn't be. Or you're looking at it on an accrual basis when we should be looking at it on a cash basis. So let's not jump to conclusions on these things. If we're close to a threshold, let's look at it. But this is an encouraging example for a firm that would otherwise be really struggling. And so I think that's the takeaway here. One caveat before we leave this slide and get to wrapping up with your questions. The simplified example we've presented here ignores the fact that while PPP money is truly tax-free, the ERC credit has some tax ripple effects. And so there is going to be a reduction in otherwise deductible wages. And so if you're looking on it on an after-tax basis, we might not get all the way back up to filling this revenue decline hole that COVID created, but certainly is a cause for hope for a company in our example that would be struggling and potentially questioning its ability to carry on. So, Jeremy, with that, you've been monitoring some questions. Let me be quiet for a minute, jump there, and we can tackle them together.
Yeah, sounds good. Before we go on to this last one, I would also say, Mark, that you and I have now probably spoken on these issues, I'd say approaching, I don't know, cumulatively maybe 10 hours. I think 2 minutes ago, you made history whenever you said the PPP is easy. I don't think we've ever uttered those words yet in a presentation. So if you had that on your, COVID PPP WK presentation bingo card, congratulations, you win. I don't think we've ever used that term before, but it is true in that case. We did get some questions related to this before we move on. So Daryl asked if you use 2020 payroll data for the PPP2, what do you use for the FTE base period? This wasn't explicitly talked about in any of the guidance or in the act. So therefore, all of the provisions of PPP1 continue on, both prospectively for first draw loans as well as for second draw loans, unless they are explicitly changed. And that's one of the items that is not mentioned. So I think you're still comparing to the same base period, covered period for PPP2 loans that you were for the first draw. The only thing that changes is you're now counting FTEs in your new covered period as you request forgiveness on the second round of PPP loans. And I think that question's a great one because it does remind us that unless they changed anything, we're still under the old rules that we were before. We did get a question about PPP2 draw loans to make sure that the 2.5 is not cumulative. So, it's a 2.5 multiplier times average monthly wages. They wanted to make sure if you already got a maximum PPP1 loan that was based upon 2.5 times, you're not maxed out. And that is correct. You are not maxed out. Think of these as two independent loans. So you could get, if you qualify and are under the maximums, the 2 million max for the second draw, if you use the same payroll data, use the same 2019 payroll data, you're going to get an identical loan to what you received the first go around. You're not limited in any way because you got the max the first time. So again, I think those are two things to keep in mind. We got some questions on the farm, self-employed farm. There is a separate farm rental form. The question was, does that qualify for the PPP loan based upon gross versus net? My assumption on that is that it does not apply to farm rentals. It is very clear in the act that you have to file your farm income directly on a Schedule F. And so I think if you're on the farm rental, you don't qualify because you don't report on the F. And that is consistent with how they've treated other rental income, about whether or not rental income is qualified as self-employment income. Generally speaking, that's been excluded from purposes of these calculations. They've always looked at the Schedule C or the Schedule F. And then cash compensation, generally, as we talk about those benefits, you take cash compensation, limit it to 100,000, and then the employee benefits are layered on top of that as you look at maximum amounts. So we got a question about that. Again, it gets complicated if we talk owner comp, so we're not going to talk owner comp now because we still want to keep PPP simple for the remainder of this presentation. But those are the questions I think that we missed earlier on in the presentation. So with that, we have this last item, and here we come full circle to the very first thing that we talked about one of the first things that we talked about whenever COVID hit whenever things started shutting down around last March, was the Families First Act. And so that actually made a requirement for smaller employers, so generally those with under 500 employees, they had to provide emergency sick leave, again, up to 100% of pay. In some instances, less than that, depending on why you were out on sick leave, whether it was personal COVID-related reasons or to care for somebody who had COVID. You had to provide this sick leave for up to 2 weeks of that sick leave before your employee had to use any personal sick leave. that they already had, or personal time off. In addition to that, after that first 2 weeks, it then provided for another 10 weeks of family and medical leave at 2/3 pay to care for a child whose daycare or school was shut down due to COVID. Okay. In addition to that, though, to make this non-burdensome to the employer, the employer was reimbursed for providing this. So to the extent they provided these benefits, they received a refundable payroll tax credit. In other words, to shift the cost of this to the government. So that requirement expired at the end of 2021, and it was not extended in this way. There is no longer a requirement that a business provide the 2 weeks of emergency sick leave and the additional 10 weeks of emergency family medical leave, FMLA. You do not have to provide that. But if you continue to provide that on your own, even though it's not mandated, up through Q1 of 2021, those credits are still available to you. So your decision point is, as a business, you are no longer required to provide that extra sick leave and FMLA under the Families First Act. But if you choose to provide it, those credits are still available to you up through Q1 of 2021. And so that's your decision point now, is whether you decide to continue on with those benefits for Q1. And if so, regardless of what decision you make, you need to be communicating that now with your employees. So just the last thing that we wanted to keep in mind as it relates to all of the changes. And again, is with this, we're coming up on the end of our 90 minutes. We'd be happy to answer any additional questions that you have at this time. It looks like, I believe we've made most of those. If you want to continue on, Jen, just to the next couple slides, just to give, again, we're not going to go over any of these, but this was a massive bill. It was both an annual funding bill, an appropriations bill, as well as a COVID relief bill, all jam-packed into one super real streamlined 5,600-page bill. And so included in that are a ton of other provisions, both business-related and tax-related. We've listed some additional provisions here as it relates to individuals. We've listed additional provisions as it relates to businesses. We've listed some additional energy credits and energy incentive provisions that were extended. By no means are these even all inclusive. And again, we've not talked about the EIP payments. We've not talked about extended unemployment. There is a lot here in this bill, massive. So we've chosen to focus on those things that are right now most important to business owners, but there's a lot there. So again, as you guys continue to have questions, here's reference. Please reach out to all of us individually, reach out to me, Mark, whoever you work with at Williams Keepers to talk through this, because there's a lot here, and we're going to continue working with you guys through this. This obviously still isn't the end. But again, a lot of action to come as we look at these new PPP loan, as the process opens back up. Hopefully now that we have the information we've been through this process once, hopefully things are a little bit easier. But again, there's some big decisions to be made. And I think Mark's cumulative example points that out, that there may be some big dollars on the table that we didn't expect related to those businesses, small businesses that had a specific downturn that received a PPP loan. So again, more to come on that, more to come from us on this, but we just want to make you aware of those items behind the questions. Again, just for your reference, but again, we're not going to go over these in any detail today. So anything, Mark, that I've missed that we need to cover? And we've got one open question, it looks like.
Yeah, Jeremy, we just had a question come in from Kat, and it says, if we count we're going to operate on a calendar year, does the COVID tax credit for employee sick leave, so the FFCRA leave that we just closed with, does it start over in January so that someone who, let's say, used it all in December is out, or does it reset annually is the question. And last I looked at this, I think that was still one of the open questions. Jeremy, do you have a better answer than I do on that?
Kat, we'll have to follow up separately on this. And I don't know if I have it immediately available. I thought that it might be cumulative. So in other words, if you had, I say cumulative, that may not be the best word, but if you had utilized their 2 weeks, I don't believe it reset. So I think you're still subject to overall 2 and 10, 2 for sick leave, 10 for FMLA. I don't know that these provisions reset, but I'm not 100% certain on that. So we'll have to get back to you. It may very well be an open item.
Because again, to frame it, what we're talking about here is really whether you qualify for a tax credit to defray the cost.
Yes.
And the tax credit is tied to you extending that which existed on December 31st.
Right. Yeah, because
so
your policy, sorry, Mark, to interrupt, you can do whatever you want, if that extends out. But yeah, it's really the credit portion of this.
Right. And the credit,
one of our associates sent me a message saying that they've looked at it a little bit, and from what they found, it does not reset. So, but there's no clear answer. So again, it appears that the credit may top out at the 2 weeks and 10 weeks per employee, regardless of if you continue this on, but there's still a little glimmer of hope and some daylight related to that maybe the credit is eligible, but as of right now, it's leaning towards not. So Angela, thank you for that. Yeah, and Megan, okay, so Megan, thank you as well. Yeah, it seems like it appears to be a one-time use. So it looks like the credit does not reset, but if we get additional guidance on that, we will alert you to that. Lisa asked a question, is the idle advance of $10,000 a forgiven loan? You bet, in that if you receive the advance, previously was treated as an advance on your PPP. So when you got PPP forgiveness, you had to pay back the $10,000 idle advance. You no longer have to pay that back. So it's an additional benefit above the PPP loan. And again, if you've already filed for forgiveness and your PPP loan forgiveness was reduced by the amount of the idle you received, the EIDL advance, you are now eligible to get that advance back. And again, I don't know what the mechanism for that's exactly going to look like. I'm not sure SBA has worked that out yet, but you will get that back. And again, I think that the other piece of that is a lot of these other benefits as we talk about taxation, these idle grants, these idle advances, the shuttered venue, to the extent you receive that type of benefit, that's also not taxable income to you. And no deduction is reduced for use of those benefits either. Yeah, and that's what, and yes. So yeah, I just got a comment or question about that. Yeah, the same thing, if you receive the benefit from the idle, like that advance, that's not taxable, nor does it reduce expenses. Individuals that had the 7A loans where the government was making the payments of principal and interest on their behalf, that as well has been deemed to not be income and also will not reduce any deductions or tax benefits. So just something to keep in mind related to that. The ERC credits, Taylor asked in the chat before we get to the other Q&A. Mark Taylor asked, the ERC credits would have to be made via amended 941s. Am I thinking about that correctly? Once we find out what qualifies for sure, we'd go back and amend the appropriate quarter. I think, Mark, I'll give my opinion and then kick it to you to see if you agree. I think this is potentially an open item, correct? I think it appears that they gave you the option to amend, but not exactly clear. It appears they give you the option to catch up in Q4, but not entirely clear. Did I state that correctly?
Yeah, no, I think that's right. I think that's where you could read this particular provision, and Jeremy's seen my Frankenstein creation from cutting and pasting the text of the December Act and trying to insert it into the text of the original Act and see what it actually really says. And the provision that talks about the mechanics of how to claim this is really not very clearly done. And so what I think was the intent, and we'll see how close Treasury comes when they actually come out with form instructions to this intent. But I think their intent was to allow companies to take these retroactive credits, which I believe were intended to apply on all wages, not just healthcare costs, and claim them as though they were paid in Q4, and just tack them onto a Q4 filing. that's not yet due. I think they were looking at it, but the longer it takes for Treasury to come out with guidance on this, Q&As on this, the harder it's going to be for that simplified approach to even be possible. So we wait with bated breath to see exactly what the mechanics are going to be for getting this onto forms, and whether we think we can go back in my examples and claim, $400,000 benefit or not. But we will be pushing out more information as it becomes available on this, because I know it's a big deal for people, especially those that had a significant 2020 revenue decline in a particular quarter.
Yeah, it's the unfortunate byproduct of significant amount of changes drafted in a relatively short period of time. I can know the amount of time it takes for us to review these. You can only imagine, again, to actually draft this. And so, yeah, more to come on that. It's easy to see how that happens. Additional questions. Sue asked, if an employer voluntarily chooses to voluntarily continue with FFCRA, so the Families First Act, and an employee has exhausted their tax credit benefit in 2020, is the employer required to pay the leave without receiving the tax credit in 2021? No, it is voluntary. Your use of the word voluntary is fantastic. The business can voluntarily choose to continue on, or they can choose not to. The only point is if they choose, so even though they were subject to the benefit in 2020, there's no requirement that you have to continue to provide or continue. And if they've exhausted it, I don't think there's any reason you would have to continue that on into 2021. If you did choose to continue it on and we found out that the credits reset, then maybe you're eligible for the additional credits. But yeah, there is still no requirement, regardless of what you did in 2020, there is no requirement that you have to continue that on in any way, shape, or form, regardless of whether they exhausted it or not into 2021. It is entirely voluntary.
And Jeremy, we're getting a few questions in here, and I know that some people had to drop off for time. So for those of you who are left, we did want to make an announcement that we will be sending out a link to the slide deck to all participants following this. So if you're feeling any anxiety about having access to these materials or looking at particular examples, we will have the slides and the recorded audio available following the presentation, and we'll send out a link to that.
Yeah. Yeah, exactly. We'll have all of this on there following this presentation. One question that I see, I'm looking through the chat. I don't see any others in the chat. Thank you, Lynette. Appreciate it. A comment from Lynette. We'll take it. It's not a question, but thank you, Lynette. Thanks for your participation. Sally asked a question. Are the farmers' funds, I presume related to the additional PPP funding for farmers, are those different than what was received through FSA? It should be. In other words, anything that we talked about related to the farmers being able to go back and receive PPP loans under, based upon gross income, all of that is related to the funds set aside for and appropriated to the Paycheck Protection Program, and is separate from any other aid that would have been received by those farmers. Okay. So with that, I'm not seeing any additional questions. So from my perspective, personally, thank all of you, throughout this process for your attendance throughout this. Again, this has been complicated. We use the term roller coaster not lightly. I think it is in some ways how we've dealt with this, again, based upon continuing guidance. We've seen a lot of hurry up and wait. Here, do this. No, let's wait. It may not make sense. And in all instances, we have in mind, how can we try to help benefit businesses the most? And so we appreciate you guys hanging with us through this. We appreciate you hanging with us through all of these presentations. Again, looking forward to a great new year. And again, definitely appreciate all that you allow us to do for you. Is that, Mark, anything else we need to add before we wrap it up?
No, thank you. I know that starting starting the year off with new rule changes is exhausting, but I hope everyone has a very good start to 2021, and I hope by the end of it we have lots of things to celebrate together.
Absolutely. All right, we'll see you next time, everyone.
Bye-bye.